Something is very wrong at the world's most powerful silver exchange. The numbers don't lie. I've been staring at this data for 3 days straight, and I still can't believe what I'm seeing. COMEX, the exchange that literally sets the silver price for every country on Earth, is running out of silver. Not slowly, not gradually, fast. And the math points to one terrifying date, March 6th. That's when the registered silver vaults, based on current drainage rates, hit zero. I want you to understand something before we go any further. This isn't theory. This isn't speculation. This is warehouse report data, filed publicly, updated daily. And what that data shows should be front page news on every financial outlet in the world, but it isn't. So let me show you exactly what's happening. 5 months ago, COMEX vaults held 200 million ounces of registered silver. Registered means deliverable, silver that can actually be handed over when someone demands it. Today, February 19th, that number is 88.79 million ounces. That's not a small dip. That's 111 million ounces gone in 5.5 months, vanishing at a rate of 20 million ounces every single month without a single day of recovery. Let me put 20 million ounces per month into a number you can feel. Global silver mine production runs about 820 million ounces per year, which works out to roughly 68 million ounces per month. So COMEX is hemorrhaging the equivalent of 30% of the entire world's monthly silver mine production from its deliverable stockpile. And it has been doing this every single month for 5.5 months straight. Here's what makes it even scarier. The decline isn't linear. It's curving downward, accelerating, getting steeper every single week. From August through October, the drop was manageable, almost boring. Then November and December, the pace picked up. January, it jumped sharply, and February's numbers are the worst we've ever recorded. This isn't a market correcting itself. This is a system losing control. And some people will immediately say, but what about eligible silver? There's more in the vault that hasn't been registered yet. That argument sounds smart until you look at what the data actually says. The 20 million ounce monthly drain is the net number. It already accounts for every single transfer from eligible into registered. Even after every eligible to registered transfer is factored in, the vaults are still losing 20 million ounces per month. The eligible buffer is not plugging the hole. It's not even slowing it down. Now add a second crisis running simultaneously. And this is where March 6th becomes not just a number, but a deadline. The March to May futures contract roll is failing. In a normal futures market, traders who hold contracts near expiry roll them forward. They don't want physical silver, they just want the paper position. For March to clear safely before first notice day on February 27th, the roll needs to move approximately 6,000 contracts per day. That's 30 million ounces worth of paper moving from March into May every single session. Yesterday, the roll moved 3,000 contracts, half speed, exactly half of what's required. March open interest on February 19th sits at 53,9952 contracts, each representing 5,000 ounces, totaling 269.76 million ounces of silver, still committed to March delivery. When March open interest fell by 3,111 contracts yesterday, May open interest only rose by 2,418, meaning roughly 700 contracts didn't roll anywhere. They either closed entirely or they're standing for delivery. 700 contracts that vanished from the roll aren't going to May. They want the metal. And with 5 trading days left until first notice day, at the current pace, tens of thousands of contracts will still be standing in March, on February 27th, demanding real physical silver from a vault that's already lost more than half its supply. There's a third alarm bell ringing that almost nobody in financial media is covering, and it's one of the loudest signals in all of commodity markets. Silver is in backwardation. March futures are trading at $77.60. May futures are at $78.20. In a healthy market, later delivery months cost more. Storage fees, insurance, time value. The further out you go, the more expensive it gets. That's normal. That's how futures markets are supposed to work. When the near month trades at nearly the same price as the far month, the market is screaming one thing. I need silver now, not later, right now. Backwardation in a major commodity is not a technical footnote. It's a panic signal. It means the market is so desperate for immediate physical delivery that it's willing to pay a premium for metal today versus metal in 2 months. Silver is ringing that alarm bell right now, loudly, every single trading session. Now let me show you the delivery data, because this is what separates a temporary problem from a structural collapse. In February 2026, the delivery rate on COMEX silver contracts was 98%. In a normal futures market, 5 to 20% of contracts stand for delivery. The rest roll forward or settle in cash. 98% standing for delivery is not a futures market functioning normally. That is a physical allocation queue. January 2026 told an equally alarming story in a different way. January is historically a quiet month for silver deliveries, a minor contract month where volume is low and delivery demand is minimal. In January 2026, COMEX delivered 49.4 million ounces of silver, 4 times the January 2025 level, 7 times January 2024. A minor delivery month turned into one of the largest delivery events in COMEX history. Traders aren't waiting for March anymore. They're front-running it, grabbing silver in January and February while they still can, because they don't trust the vault will have it in March. And zoom out to the full year. Total COMEX silver deliveries in 2025 were 474 million ounces. In 2024, the number was 202 million, more than double. Every single month of 2025 posted higher deliveries than the same month in 2024, 12 consecutive months of record-breaking delivery demand. This is not a blip. This is a permanent structural shift from paper trading to physical metal demand, and the vaults were never designed to absorb this volume. There's one more factor accelerating the vault drain that doesn't show up in most analyses. As the gap between the Shanghai physical silver price and the COMEX paper price widened to $18 per ounce when silver pushed past $120, silver started physically leaving New York and moving to China to capture the arbitrage premium. COMEX isn't just losing silver to delivery demand, it's losing silver to international arbitrage, metal flowing east because the price is higher there, and once that metal leaves, it doesn't come back. The vault is being drained from 3 directions simultaneously. Domestic delivery demand pulling metal out the front, international arbitrage pulling metal out the side, and direct mine to buyer deals preventing new metal from entering at the back. 3 simultaneous drains. 0 recovery days. Now I want to show you the smoking gun. The piece of evidence that proves beyond any argument that the paper price on your screen is not the real price of silver. Today, First Majestic Silver, one of the largest primary silver miners in the world, released their full year 2025 earnings. Their numbers are extraordinary across the board. Q4 production reached 4.2 million ounces, up 77% year over year. Full year production hit 15.4 million ounces. Revenue for the quarter was $463.9 million, up 169%. Full year revenue reached $1,257 billion, and they swung from a loss to net income of $211 million. They ended the year with $937 million in cash, tripled from just $38 million the year prior. Record quarter, record year, every metric at an all-time high. But one number buried inside those earnings tells the entire story of what's really happening in the silver market. The average COMEX silver price during Q4 2025 was $55.20. That's the official benchmark. What the exchange says silver was worth. First Majestic's average realized silver price was $69.74 per ounce. That's 26% above the market price, $14.54 more per ounce than what COMEX said silver was worth. And this isn't an isolated case. Earlier this week, Hecla Mining, the largest silver producer in North America, reported their numbers too. Hecla's average realized price was $69.28 against a benchmark of $54.83, a 30% premium. 2 mining companies, 2 different countries, 2 completely different operations, different cost structures, different customer bases. Both got $69 for $55 silver. Both filed these numbers with the SEC, audited on the official record. I want you to sit with what that actually means, because it's the key to understanding this entire crisis. If COMEX was functioning properly, if the exchange could reliably deliver silver to anyone who wanted it, no rational buyer would pay $69 for silver they could buy for $55. They'd simply buy the futures contract, stand for delivery, and take the metal at the cheaper price. The fact that industrial buyers are choosing to pay $14 more per ounce, voluntarily, knowingly, with full awareness of the COMEX price, tells you exactly one thing. They don't believe COMEX can deliver. These aren't amateur investors panic buying silver coins. These are Samsung-level industrial buyers, semiconductor manufacturers, defense contractors, tech companies, whose entire production lines stop if silver doesn't arrive on schedule. They would rather pay 30% more and guarantee delivery than pay 30% less and risk getting nothing. That is a formal vote of no confidence in the world's largest silver exchange, filed not with words, but with $14 per ounce. And we already know Samsung locked up 100% of output from the La Parrilla silver mine through a direct prepayment deal. That was the first signal. First Majestic and Hecla's earnings confirm it's not just Samsung anymore. It's a pattern, and the pattern is accelerating. Every ounce that industrial buyers purchase directly from a miner is an ounce that never enters the COMEX system, which means the vault drain isn't just about delivery demand exceeding supply. It's about supply being systematically rerouted around the exchange entirely. The more the vault drains, the less confidence buyers have in the exchange. The less confidence they have, the more they go direct to the miners. The more they go direct, the faster the vault drains. And the faster the vault drains, the less confidence anyone has. This is not a problem with a natural equilibrium. This is a feedback loop with no floor, A death spiral that's already in motion, already accelerating, and has been running for 5.5 months. And then the US government stepped in and said something today that ties every piece of this together in a way that should make every short seller on COMEX very nervous. Undersecretary of State Jacob Hellberg commented on the critical minerals price floor system the U.S. has been building since Vice President Vance announced it on February 4th. A reference price system for critical minerals, including silver, maintained by tariffs, with the EU, Japan, and Mexico already on board. Today, Hellberg went further. He said they've developed a very sophisticated price floor mechanism, and then he said these exact words: "Pricing is the key to unlocking private investment. Pricing is the key." A sitting U.S. government official just told the world, on the record, that current silver prices are too low, that the government has built a system to make them higher, and that they are, quote, very excited about it. When was the last time a government official was excited about making any commodity more expensive? Think about that question seriously for a moment. The U.S. government doesn't get excited about price increases. They fight price increases. They hold hearings about price increases. But when it comes to silver and critical minerals right now, they are actively building infrastructure to guarantee higher prices and announcing it with enthusiasm. Now consider the position of the commercial short sellers, the bullion banks that have been fighting to push silver prices down, that crashed silver 46% in a single session on January 30th to wipe out call options and frighten longs into selling. Those shorts are now operating against the stated policy of their own government. The same government that controls tariff policy, the same government that just launched Project Vault, a $12 billion strategic minerals reserve, the same government that stood in front of 55 countries and announced a permanent price floor for silver. The bullion bank shorts aren't just fighting the market anymore. They're fighting Washington. That is not a position that ends well. Let me give you the 5 specific signals to watch over the next 5 trading days between now and first notice day on February 27th. These are the exact numbers that will tell you whether this situation is getting better or about to break. Signal 1, the daily roll rate. March open interest needs to drop by at least 6,000 contracts every single day. If it's not hitting that number, the roll is falling behind, and the pressure building for first notice day is growing, not shrinking. Signal 2, registered silver levels. We're at 88.79 million ounces today. If we drop below 85 million before February 27th, delivering into normal March demand becomes mathematically nearly impossible. Signal 3, the March-May spread. If backwardation deepens, if March starts trading at a larger premium to May, it means the market's urgency for immediate physical metal is increasing, not stabilizing. Signal 4, margin hikes. If the CME group raises initial margin requirements on silver futures in the next 5 days, that's the exchange's early warning system telling you they see the problem, and they're trying to force smaller position holders out before first notice day arrives. Signal 5, the eligible category. If eligible silver starts declining alongside registered silver, it means even the silver sitting in vaults that isn't currently available for delivery is being pulled from the system entirely. That is the single most alarming scenario, because it means the buffer that everyone assumes will save COMEX is disappearing too. I've been tracking this data every single day for weeks now, and every day I look for the counter-argument. I want someone to show me the chart that says the vault is recovering. I want someone to explain how the roll will catch up in 5 days when it's been running at half speed. Every day I look, and every day the numbers get worse. Not ambiguous, not sideways. Worse. The vault lower, the premiums wider, the roll slower, the backwardation deeper. The data has been consistent for 5.5 months. At some point, you have to trust what it's telling you. Here's where I stand personally, after weeks of daily analysis. COMEX is heading towards some form of intervention before March is over, whether that's margin hikes, emergency position limits, cash settlement premiums, or something we haven't seen before. The $69 realized price from both First Majestic and Hecla is closer to the true value of silver than anything displayed on a futures screen. And the government price floor announcement is not a temporary policy. It's the beginning of a permanent structural shift in how silver is priced globally. Here's the most important thing I want you to understand. You can raise margin requirements. You can crash the price 46% in 24 hours to scare sellers into the market. You can change the rules of the exchange mid-game, as they did to stop the Hunt brothers in 1980 when they banned buying and allowed only selling. You can offer cash premiums to convince holders not to stand for delivery. You can do all of these things, but you cannot manufacture silver that doesn't exist. You cannot refill a vault that has lost 101 million ounces in 5.5 months without a single day of recovery. You cannot unreport audited earnings showing 2 independent mining companies both received $69 for $55 silver filed with the SEC on the permanent record. And you cannot convince Samsung, and the semiconductor manufacturers and the defense contractors and the tech companies to go back to trusting an exchange that is running out of the one thing it exists to deliver, the system is already speaking. Every vault number, every delivery rate, every earnings report, every government statement, every contract that fails to roll is saying the same thing in different words. There is not enough silver. The paper market's time is running out. In the physical market, the one where industrial buyers pay $69 for $55 silver and lock up entire mines through direct prepayment deals, that market has already moved on without it. 88 million ounces remaining, 20 million vanishing per month, 5 days to first notice, a roll running at half speed, a government building a price floor, 2 miners at $69, and a chart that points to 0 on March 6th. Drop a comment and tell me, does COMEX make it through March without a rule change? Yes or no, and tell me why. I'll pin the strongest arguments from both sides. If you know someone who still thinks the price on their screen is the real price of silver, show them the vault chart. Show them the miner earnings. Ask them to explain how 2 companies in 2 different countries, both independently, got $69 for $55 silver. I'm covering every data point between now and February 27th. Vault numbers, roll rates, spreads, margin changes, all of it, every day. Subscribe so you don't miss what happens next. This is the hidden economy. Stay sharp. Stay stacking.